The first thing I'd like to do is spend a little bit of time with you figuring out what it is that you want to get out of this presentation. I have a presentation, I can go through it and we can do the college lecture mode and you can sit there and I can talk, or I can find out what you want to hear about and then I can address that as we go through. So just so you have an idea of what topics I can cover, I cover really a broad range of commodities for Rabobank and positioning from an internal strategy and also trading perspective, everything from livestock to grain and oilseeds. I also work with financial markets, so looking at where the financial markets are going and what the impacts will be on agriculture and producers to help position the bank internally. And I do a number of other analysis as well, global supply and demand and global trade. We develop models that we ground also in truth so that we can have these views to position Rabobank, which is a global player in agriculture. It's about nearly $1 trillion bank, and the primary asset is agricultural lending. So globally, it helps us to have a very strong understanding of what's happening in markets and where things are going. So we have to have this strategic type of insight. So with that being said, I'd like to just give you a few seconds, and Steve is going to actually write this down on the flip chart up here. What are some key things that you would like to know that are keeping you up at night that I might be able to have some discussion about today? And I have to warn you up front that I'm not afraid of slight pregnant pauses as I listen. Where are we going to sell our hogs? Okay, and I'm assuming this is a trade discussion. Okay, good question. We can talk about the dynamics of that. Anything else? Other things that you're thinking about?
I'm kind of interested in the demand for animal protein globally and the importance of international trade when we rely so much on exports and our administration's concern and sometimes ignoring international trade agreements that we've negotiated.
And I get, so the question is international trade, what the demand for animal protein is globally, and then some of the policy discussions behind that and what's happening and what the importance is. It's a good question, and I get also a veiled TPP bill there from pulling back from that agreement.
Yeah, I don't understand at all the logic of an American negotiated agreement and wanting to withdraw.
Okay. And so we can talk about that. That's so very good at global trade. Any concern with financial markets?
Yeah, a little bit on the U.S. financial markets, with the up and down, and then world economy kind of, what's it look like this, where we're exporting as much as we're exporting, a strong world economy is
very important, yes. Okay. Good.
Foreign investment in the United States.
Direct foreign investment in the United States. Okay. Particularly agriculture or just in general? Okay. Direct foreign investment. Good. We've got a pretty good set of things to cover. Anything else is burning? If you have something, let me know as we go through.
The increased factor capacity we've got going on, and how we're filling that, and if it's going to be, how it's going to work as far as the extra capacity and how it's going to flow from. How we're going to fix it.
Increased factor capacity. All right. Good. If you have other things that come up while we're having this discussion, just feel free to please raise your hand, and we'll get it on the flip chart here. So Steve is always also going to try and keep me on schedule here. In my life, I've been accused of a lot of things. One thing I've never been accused of is talking too little about any subject. So Steve is going to try and keep me on task as we go forward. So let me start with, and I'm going to do this a little bit because of the way that this presentation is laid out. Let me actually start with the financial side, because that's really one of the key drivers here. And for those that just came in, these are just some of the questions that we have gotten from everyone that they have burning questions. If you have things that you want to hear, just raise your hand and we'll get them on the docket. So from a global financial perspective, first of all, we start with the dollar index, and we look at the dollar to see how it's performing against other currencies to determine where the strength of different economic growth is. But in agriculture, we have to be very careful with using dollar indexes, because the dollar index that you hear quoted every day on any business channel is about 80 to 85% influenced by the euro. We frankly don't do agricultural business with Europe. It's not a big driver of anything that we do. So when we look at a dollar index, we actually look at several different things, different currencies, benchmark currencies. The key benchmark currency, of course, of Japanese yen, and then also the Canadian dollar, the Brazilian real, the Australian dollar, and one of the most important currencies to us in the United States. Does anyone know what that is? Well, China is important, but actually this one is even more important. Japan's very important. This has become even more so. The Mexican peso. Okay, a lot of people don't understand, as you were saying, what the importance of these global economies are to the U.S. market, especially to the pork industry, Mexico. Last year, we had two things that occurred. First of all, Mexico imported a record amount of pork from the United States, about 1 million tons. You might say they saved our bacon, but they didn't really save our bacon, they saved our ham, because it was almost exclusively ham that they imported. And the time that they imported it was the time when the exchange rate from the peso was the worst. So while the ham was more expensive because the peso was losing value, they imported more ham than they had ever imported. So it was very inelastic. And that economy has become essential to the U.S. economy going forward. So right now, from a economics perspective, these are currencies compared to the U.S. dollar. The U.S. dollar has gained strength because our economy is improving. There are several very strong underlying indicators that show that the economy is improving in the United States. And it's going back to what we call a normal level of exchange rate with historic values. It's where it should be, actually. The last, go to 2015, back to 2008, that's not where the dollar should trade. So right now the dollar is making a move back into that normality of trade. The global economy in China is doing quite well. In fact, they're getting back up to where they may go above the 7% growth rate that signifies a strong, growing Chinese economy. So in China, it's going quite well. China imports a substantial amount of offal and trimmings from the United States. Mexico is a key. Mexico is doing reasonably well. They've had some little clunks along the way, but they continue to consume new products like ham at an ever-increasing pace. So right now, the Mexican economy, from at least that consumption perspective, is doing well. There are some issues occasionally with the peso, especially when we start rattling the NAFTA saber, because Mexico is very reliant on the United States for their economic growth. And we'll talk a little bit more about NAFTA and what the agenda of the Trump administration is and what they're trying to achieve with all of this talk and rattling and everything they're doing and what the impacts could be. But Mexico is very important. The Canadian dollar is going back to where it normally has been historically, trading a little less. It should not be on parity with the U.S. dollar because the Canadian dollar is a commodity dollar. It's primarily a commodity and export economy. The United States is an export economy, but is primarily driven by consumption. So everyone in the United States know that we do some things very well. We eat and we buy. Those are two things we do for the world economy. Eat and buy. Those are great. Keeps everything moving. So the Canadian dollar is about where it should be. Canada looks reasonably strong, but interest rates are starting to increase there. There's some question as to whether they're trying to stay at pace with what the Fed may do, but it really looks like it's on their own, and they're increasing rates, which means they're having some inflationary pressure in their economy right now. But overall, it looks reasonably good. And then Brazil, of course, it should be doing better than it does. A lot of the corruption issues that are going on have driven the real to lower levels, which gives them an advantage in exports, especially from a soybean and corn perspective. And that will probably continue to be into the future. So on the whole, the global economy is very strong. It looks good right now, going into 2018. Every economy seems like it's moving at a reasonable pace. Europe is also expanding, and so things look optimistically good right now in the short term. There's some issues that we can talk about that are developing, especially in the U.S. economy, that long term, a little longer term could be a problem. But right now in 2018, we watch about somewhere between 16 and 18 indicators, and right now all but 3 of those are green, which means that things are moving forward. That's one of the reasons why we have seen such strong movement in securities, because of the strength of investment in companies expanding their returns, but their returns aren't expanding as fast as the investment is. And so if you see that blue line right there, that's the S&P 500. This is a very strong bull market that has been driving forward. It's been driving for some time, and it's driven up to record levels. You can't turn the television on at night anymore without hearing that there's a new record set. We set 86 records in 2017 for new highs. That's pretty substantial. That's a very strong bullish run on those markets. The thing that's concerning, one of the things that's concerning and to keep an eye on, is the spread between those securities or the paper assets and the actual hard assets. Just take corn, for example. Normally, one corn contract has the value of the Dow Jones. It generally runs about 1-to-1, somewhere around there. In the last few weeks, it's been running about 1.7-to-1. So the Dow has outpaced commodities nearly double where it likes to be. That means that a lot of money is flowing towards those assets, those paper assets. And we're seeing trades now where the asset values of those companies are trading at higher than 10 times the asset value. All right, so that the paper is trading 10 times higher than the asset value. There's some keys with that. When you get that kind of a separation, it means that you have commodities that start to look very inexpensive relative to the securities. And short periods of pullback, or even if we get to what we call a euphoric top on this market, generally means you get a lot of volatility on the commodity space because you rebalance funds. They start looking for safety. And they start moving into agricultural commodities partially, and also silver and gold and agricultural land and other things that are safe havens, to rebalance those portfolios and take some of the risk off the table. And so this is likely to play out this year a little bit as you see challenges in the market. So looking at this, and we have to be careful, I've got these two terms right here, pullback and correction. We get a movement in the market like this. It drives up, and then it comes back, and then it drives up again, and then it comes back. If it's about 5%, that's called a pullback. If it's 10% or more, that's called a correction. The market won't top and come down unless there's something recessionary involved with it. So right now, we saw this happen just recently. About an 8% pullback yesterday. It was 8%. It wasn't 10%. It wasn't a correction yet. It was a pullback. So the market, these are healthy. What this means is the more risky parts of the market usually are being devalued. So risky investments are being devalued. Up until that point, we'd seen several things like $2.5 billion per week going into high-risk lending companies. If that needs to pull back. You need to see that. So you'll see these pullbacks, and when you see the pullbacks, you can also see subsequent volatility on the commodity side. Well, that's how that impacts the commodities. Eventually, though, this is likely to come off. There are some serious, even the potential for bubbles being developed in this bull run economy that could cause some long-term economic downward movement. And so we've got to watch it really closely. This year is going to be the year of inflation. That's the key word everyone's going to talk about, inflation. And if we see interest rates rising, then there's some things you can watch. First of all, unemployment is at 4.1% or so right now. It's lower than it's been since the height of the dot-com bubble at 3.8%. What usually happens is you get a very low rate of unemployment. And then if you see a subsequent quick increase, then you're nearing, that's a warning that this economy may be nearing a top, and we might see some liquidation or even a meltdown in the securities. Usually in those situations, especially feed becomes very volatile. And it's a good idea to have a plan in place of how you'll hedge against that volatility if it happens. You can't forget about the volatility. But right now, the economy looks good. There's still some room left. But these things don't generally last forever. And it's very hard to time it. And so having a plan in place of how to deal with volatility and how to hedge is very important at this point, especially from a feed perspective. So that covers kind of the financial markets. Did I miss anything there? We expect to see reasonably strong imports into Mexico this year. China seems like it's going to continue with its importing. Those are two of the key growths in the swine market over the last few years, and so that looks reasonably good. So any additional questions about the financial market? We can come back later and talk about it. Steve, where am I time-wise? Okay, so let's go. I didn't hear anyone ask about corn, so I'm going to skip this unless you're commodity prices. Is anyone interested in where we see corn prices in the future, or should I skip it? Okay. This is an Economist, Econometrics graph. We put these up. It's really a very simple concept, but we try to make them look really complicated so that we have job security. This way, you need us to interpret it. Stocks to use is just taking the ending stocks divided by use. And price is just the contract, the CBOT price for the particular grain. Generally speaking, in July is where we see a lot of volatility recently. And it gives us an idea of where the market is placing risk, whether the risk is up or whether the risk is down. When we look at global stocks to use and where we currently are price-wise and where the market believes that stocks to use is actually at the lower end of the volatility cycle or volatility range. So the expectation is that most of the pressure for corn price is actually going to be up over the next few months until we hit this July period. Any challenges with weather, any challenges with drought, and the market will start interpreting this as a risky situation and start trying to move the price along this line, depending on how much the market thinks we're going to contract. When we look at the December contract, which is more in line with what happens in the U.S. Pricing, we see right now where U.S. stocks to use are is very high, and there's a big headwind against prices going too high. To get to 485, 490, we estimate that there's probably a 10% probability of being here or higher, because you're going to need to have a drought that is really a 10% probability to drive stocks down that low, to sustain at that level. These are other samples, and they're actually time-adjusted months. So the market has a pattern. The point here is that the market likes to bid in a certain pattern. And there's an inflection point that happens right about 9% stocks to use, where it goes from this kind of slow slope to a very steep slope. That's the U.S., correct. And so right now our average estimate is about 3.45, 3.50 in the December contract at delivery. That's everything being average. But don't forget about the possibility of going higher, especially if we see money flowing out of securities into this that will inflate it and cause a lot of choppiness. So the long-term sustaining prices, there's a real burden to break that 490 level, but it is conceivable at about a 25 to 30% probability we could get above $4 again this year. So that's kind of our corn price outlook. All right, let's skip forward a little bit here. We've already established that the herd is growing. I think everyone knows that the swine herd is growing, and we have added capacity to our process. So as we analyze this and model it, there's a couple of key things that we've seen. First of all, consumption per capita in the United States for all protein is going up. And it's gone up more than we had expected in all the proteins, but particularly in pork and in beef. Now, pork on a retail basis, so taking the retail pork, generally likes to go at about 50 to 51 pounds per capita. That's almost an elastic long term. You can draw a flat line. There's movement around that, but it's a flat line. We dropped below that the last several years, and now we've moved back up above that 50, 51 pounds per capita. And that's driving an increased usage of pork throughout the United States. Particularly, we've seen a lot of increased usage in bacon, which is what we like to jokingly call the condiment, because it goes on everything now. And so bellies have been fairly demanded in the U.S. Ham has been moving out of the country into Mexico, which has kept that pretty balanced, leading ribs and loins, which have struggled a little bit, but also have been utilized as loss leaders by supermarkets that are trying to compete in this space with Walmart and Amazon. There's just been a lot of usage for specials and loss leader there at the case, where it's driven some of that loin movement. Now, loin has been probably the smallest increased meat that in terms of adding to the cutout value, but it's held in reasonably well. And it's because of this increased consumption per capita in the United States. When we do our estimate looking forward and looking at these additions in capacity that are kind of defined here, we start here in this year, and just making this quarterly, we see actually by 2021 or so, we're probably going to actually need more capacity based on where we are with consumption per capita, driving pork consumption in the U.S. So how does this all fit together? Well, it's created demand. We still have some additional capacity to increase in the future. But at this point, we're just getting to the point where we think we're going to be able to fill that capacity. And in the future, we're actually going to have to add capacity by 2020 or so. And this isn't anything heroic. We're not saying we're going to go out of bounds on consumption per capita. This is just population growth and projections of where this capacity will be. Over and above the current plans to double shift, at least where we are right now. There's additional double shifting that can happen, but that will be in addition to capacity. So there will be, what we're expecting is future increases in capacity, but that's probably not until down the road a couple of years. Driven mainly by demand. If we get back in that 50, 51 pounds per capita, and we continue to be able to export, that's the key. So when we're talking about U.S. demand, we're not doing anything, we're not inflating, consumption per capita. We're probably on the low end of consumption per capita estimates, but in the U.S. But we are expecting that we will have another 400,000 tons of pork exported that aren't being exported today. And we expect 200,000 tons to go to Mexico. We expect another 100,000 to go to China. And then the fourth 100,000 tons is going to have to be developed globally. So there are markets that need to be organized under this scenario to be able to take all of what we're going to produce and make this scenario a healthy scenario for the industry. So there's still 100,000 tons that need to be put somewhere. And I'll tell you who's very good at this, and every time I say it, I get some comment about buzzards or something like that, is the poultry industry. When they lost Russia, they immediately started organizing a number of very small consumers of poultry throughout the world, whether it was South America or other places, and replaced a great deal of that export with those small countries, and then all your proverbial eggs aren't in one basket. So it's something the pork industry needs to take a lesson on and not be as tied up to NAFTA. And I'll show you what I mean here. If you look at the chicken industry, that big orange square, those are other countries, non-NAFTA and China. It's only 32% dependent on NAFTA and China. The pork industry is 53% dependent on NAFTA and China. The beef industry is growing in that dependence, 59%, and a lot of that is China. And so it's the diversification of where that product goes that will strengthen and create long-term health for the industry. So this is a key to the future. Now let's talk about trade with the Trump administration. What the focus of the Trump administration on NAFTA is really manufacturing. One of the keys is the actual manufacturing of goods within NAFTA that are sold as being from NAFTA. So when you manufacture an automobile, you make the automobile, you assemble it, say in Mexico. But where do the parts come from? That's the question. If most of the parts come from China or Japan or other places, the Trump administration wants that to be exempted from NAFTA. Because it's assembled in Mexico, it doesn't mean it was made in Mexico. And so it should be subject to tariffs. And that's one of their key things that they want to address in NAFTA. Now, pork is actually exempted under NAFTA now. Mexico protected pork as a key area when NAFTA was first negotiated. In other words, if they wanted to put tariffs on pork, they could now. But they're not, because it's a very, very profitable and easy way to replace beef, which has become very expensive. And so they can use that in their diets as opposed to just utilizing the beef. And hams work very well there because they can just debone easily. So it's a little bit hard to say what happens to the pork industry. If agriculture starts to be used as a pawn in this discussion, then it's easy for me to make the case that poultry gets damaged much more than pork does. Because poultry isn't protected, and it is right now part of the NAFTA agreement, where if they were going to put higher tariffs on pork, they would have already done it. That's my logic. I don't know if that's what will happen, but that's a key. In terms of TPP, TPP again was done from a manufacturing base. And the disadvantage that the U.S. would have had from a manufacturing perspective. This administration is very focused on manufacturing jobs and jobs in the U.S. and hasn't paid as much attention to the trade issues for agriculture. I know that the Governors Conference has been very vocal in pushing agriculture and making sure that it doesn't fall off the docket or whatever they're trying to accomplish. At this point, it's very hard to say what's going to happen. I've met with Director Chin, and I know that she's been very vocal, and she's been surprised that when Missouri calls the White House, they actually get to talk to the president, which is unique. You may not know how unique that is, but there has been direct communication, and I'm hopeful that they can continue to pass that knowledge on and keep that on the agenda. At this point, though, it's a big risk. So I don't know if I answered your question, but I would say when we want to know why these things are happening, it's because their agenda is focused on manufacturing, right or wrong. That's kind of what's happened. Let's see. Make sure that I get all of these. Foreign investment. Who asked the question about foreign investment? What is it specifically about direct foreign investment you're interested in agriculture? Like who's buying what, or? Right. The answer to the question is yes. And it will be in probably all sectors. So the U.S. is a big hole in some portfolios, like China's grain system, for example. They own assets in almost every producing country except for the U.S. They own no substantial assets. There's probably an interest in gaining some grain assets here in the U.S. The ADM takeover of Bunge could result in the breakup of a lot of assets and resale to other companies like Glencore or even COFCO, which is Chinese. Most people don't know that a substantial part of our wheat milling industry is already owned by Japan, by Japanese companies. So the answer to the question is there is substantial interest in the U.S. and it will only probably continue to increase. From a trade perspective, yes, it does. It makes us more able to move our products into other countries over the long term. It's just part of the natural progression. The U.S. companies own substantial assets in other countries, so it just makes it much easier to move grain or whatever is being produced from one place to another. You can't do that easily in China unless you have a partner. And China is very interested in just about everything. Hay. We've had discussion with them on cattle. Obviously, they're interested in pork. Steve, what else have I got up there? Yeah. What other? Are there any follow-up questions to what we discussed?
You said 50 pounds per person per year per capita. If you took, like, what if it was China, India, the two big growing economies by people? Are they at 20 and 10? Or are they at?
India eats very little meat. It's mostly a vegetarian society. They do produce some poultry. They consume dairy, but in terms of meat, they produce very little. They're one of the major beef exporters in the world because they have the dairy cows and they don't eat them. So they ship them off to Southeast Asia. China, on the other hand, and I'm trying to think because I've got to convert from kilos to pounds. China is in the 25 to 30 pounds, just rough conversion in my head. Interesting, the process of meat consumption. When you look at a country that goes through an economic liftoff, so you see their GDP per capita grow quickly, the protein consumption is just as steep as that growth. So in other words, as soon as they start growing and getting disposable GDP, they're replacing it with protein in their diet. And it's a very steep liftoff. And then you hit a saturation point. You hit that saturation point, and it turns into this long, slow curve. Now, if we take Taiwan, which is culturally is very similar to China, and we put their protein consumption curve, because they're clear out here now, where they consume about the same amount every year. We can count on them consuming that much, no matter what happens with GDP per capita. China is tracking maybe a little steeper than they are, but getting pretty close now. In pork, China is probably getting close to a saturation point, but they're not there yet, where they've turned the corner on that long. They may have just barely started from the reason is because from the urban population, they're started along that line, but the rural is still moving up. They're probably about 10 years behind the urban population. Right now, it's roughly 50-50, although there's more urban people than rural now. So there's still some room for growth in Chinese swine consumption, is the point. And their population it's still growing, but in terms of demographics, it's in decline. So if you look at the Indian population, with this being young and this being old, it starts up here and it slopes down. China actually starts here and has a big bubble like this. And was kind of wearing down a little bit. So their population, like Japan, will probably start to shrink over the next 10, 15 years or so.
With the consumption of more protein, does that affect the life expectancy?
It can. The problem with China was the one-child policy. And so they can extend and also the medical technology. China is rapidly developing medical technology, partially because they don't have to worry about regulations. So they can test whatever they want to and see if it works. And I guess if they kill 100 or so, it doesn't matter to them. But that's kind of where they are. The real place to watch is Southeast Asia, particularly Filipinos, Thailand, Vietnam. Those are cultures that consume a lot of pork, and they are growing. Back in the day, what was it? Paul Revere and the Raiders. Anyone remember them? Yeah, Cherokee Nation, or that song. There's a line in there that says, "And all the beads we made by hand are nowadays made in Japan." Just follow that. Made in Japan. Then when was it? Where was it? Taiwan. Then where? South Korea. Then China. What's the next place? The next place is Southeast Asia. Thailand, Vietnam. Those economies are moving. And they're a great place to look for future growth. Steve has given me a signal here. I think we're...
Yeah, I don't want to discourage the conversation because we've got a few minutes before the next session starts. So a couple of things before we continue to stir. On the back of your packets, there's an evaluation form. Let me just pull that away and leave an extra table. It really gives those licensors feedback. Second thing is, and you're welcome to take that package, we've also got our report quarterly that comes out quarterly. And I've got hard copies. You're welcome to get a hard copy. Plus, if you'd like that email to you on a quarterly basis, I've got a pad there to fill out. You're welcome to it. So with that...
In addition to that, this presentation will be up online. If you want to get hold of it and have a look at it. I talk about a number of other things, or I should say we. Talk a little bit about the consumer in the U.S., where we're going with convenience. What about this artificial protein, artificial meat? What is that doing? It's growing, and it is stealing some of the growth from animal protein. We still see it as being very small, but it is starting to move and needs to be taken into account.
USDA is experimenting or looking into this grading system being more like a pride choice selection. And it's been kicked around. Do you see that gaining traction, or do you see that going in how that kind of evolved on the floor? I'm assuming, the loin, it's got to help the loin price. Is that what they're looking at? Yeah.
And that's going to be a really tough one, because even in the cattle, it doesn't work real well right now. It's going to be hard because of the agreements that you have on the swine industry. Most producers have separate contracts with companies, and you're paid a premium based on specific volumes, and integrating that grading system into those contracts is going to be a challenge. And I think that's really one of the big things as I talk to the guys at USDA that they're running up against, is how do you take contracts in existence that are being paid based on some qualities and also volumes of swine, and then adapt those to include a grading system, a choice prime grading system, grid. And that's been a little bit of the challenge that the USDA is having with how do you integrate this into the swine market, which is much more integrated than the beef market.
My nephew, very proud of, works for Walmart. He buys all the beef in the United States now. He recently took a trip to Australia. And they are saying that we have the world's worst beef. We haven't, apparently when you go to Australia, all the loins are the same price, or are the same size. You know, the cattle are all the same, the hogs are all the same, and the consumer knows exactly what they're going to get. They don't get a pork chop like this or like this. They get one like this, and he says that's part of the reason for this grading system, and for people to finally realize you don't want to be the other white meat. The red pork has much more flavor than the white pork. And he says that's the reason. Now, I don't know.
Yeah, there's several different purposes for it, but I have a friend that's Australian. I work with him a lot. We were discussing meat quality once, and we were asking why U.S. beef trades at a premium to the rest of the world. And there were several Australians in the room, and some of them were younger, and they were asking, why does U.S. beef trade at a premium? And he said, because it's the highest quality in the world. And that goes for where you're from, mate. U.S. beef is higher quality than Australian beef. What Australia sells is uniformity. In everything they do is uniformity. That's, you know what you're getting, you know where it's coming from, and how, because they have traceability systems, and so that's what they sell. The U.S. sells quality and prime, and we do sell it at a premium to global traders. On the swine side, we don't really necessarily sell the quality and prime because our primary traders want specific things, offal, ham, or whatever it is. Now, I would say, from what you said, the other white meat, I agree with that completely. And I've heard the argument, it's a pH thing, it's an IMF thing, it's, whatever it is that makes the pork taste good. It's a mix between pH and IMF. And coming up with a grading system, can be valuable. How are you going to integrate that? And that's really the challenge. And for Walmart, it would be great, but how does it work for producers and packers? So we'll have to watch it closely. The key is going to be how do you develop specific markets, especially these small, diversified markets that won't, so all your eggs aren't in that one basket.
I have a little problem with your continuing to emphasize exports to China when the tremendous changes that they have put forth in their swine industry. They've got several operations that are on the ground today that are producing 10 million pigs. It appears to me that our demand in China will only be for the cuts of product that we really don't want.
Which is awful, which is what we sell them now. And there's room for about 100,000 more tons over the next 10 years there. We've included all of that in our estimate, the growth in their production system. And so, yes, awful, that's what China will buy. Mexico is a ham importer and probably isn't going to change. But we need those two countries if we're going to continue to build this out. And then we need to find home for 100,000 more tons somewhere. Steve, you're up there waving your arms. I think we're about done. Yeah. I really appreciate everybody's time.